What's up, you guys? I'm Dan. This is Max. Where are you going? What's up, you guys? I'm Dan. This is Frugal Not Cheap, and today we'll talk about the 4% rule for early retirement. So in my last two videos, we've gone over parts of my FIRE, or Financial Independence Retire Early plan. First, we outlined my budget to take advantage of geographic arbitrage by living in Southeast Asia, specifically in Bangkok, Thailand. Then in the second video, we talked about how to access retirement funds early, well before the age 59 and a half, in order to fund that retirement. And today, though, we'll talk about how much we need to save in order to actually make this happen. So how big of a portfolio do we need to save? Of course, one simple way to do it would just be to take our life expectancy minus our current age, and then multiply that number of years by our annual spending. And as long as we could keep up with inflation, that would probably do it, right? For a US male born when I was, the life expectancy is 81. So that puts me at a retirement, let's say I retired at 40, of around 41 years. If we take my $21,600 budget, multiply by 41, we get around $885,000. But then of course we wouldn't want to run out of money, and hopefully I would live longer than the current life expectancy. So why don't we call it a cool million? But of course it would be really foolish to try to fund a retirement using just cash or cash-like assets, because of course we can take advantage of growth in the market by investing instead. And because of that, we need way less than that. So how are we going to figure out how much we need to have in our portfolio in order to fund our retirement? In other words, what percentage of my portfolio can I withdraw each year so that the portfolio will still be able to survive throughout my retirement? That's the question behind a very famous study on retirement called the Trinity Study. This is a study to determine what that rate is, the safe withdrawal rate, how much you can pull out of your retirement accounts each year and still have those accounts survive throughout the retirement period. In their case, they used a 30-year period, and they found that you'd be able to have your portfolio survive for 30 years with a very high chance of success if you pulled out 4% per year. And that's why we have the 4% rule. So how much would we need to save? Well, based off the 4% rule, there are 25 4% in 100%, or put another way, a quarter of 100 is 25. So we can take our budget of $21,600, multiply by 25, and we see that we needed a portfolio of closer to $500,000 than the $1 million that we were talking about when we looked at the cash scenario. We're actually looking at $540,000 in order to fund our $21,600 a year budget for 30 years with a good chance of success. Of course, the Trinity Study was done some years back, and so people since that time have been questioning, well, has it still held up with the new years of data that we have since the study came out? And other people have asked, well, what about early retirement? Is this going to work for a period longer than 30 years? Luckily, people have looked into this question, and so I don't have to do all of the basic research myself. I was pointed to a website or a blog called The Poor Swiss. You can check it out at thepoorswiss.com, and I'll have the link to the specific post that has all of the work for today's video in it. So first, let's just look at updating the data set through 2021. How did the 4% rule fare? Well, as we can see here, it continued to fare quite well, where all of the portfolios with at least 50% stocks did really, really well with the withdrawal rate up to around 4%. So that withdrawal rate is on the x-axis over here, and as that withdrawal rate, what percentage you're taking out of your portfolio each year increases, then of course the success rate goes down, because your portfolio would have to grow a lot more in order to keep pace with your withdrawals. So that success rate is here on the y-axis, and of course our target is to keep it at least above 95% or so. So the 4% rule is holding up quite well with updated data. But what about the second question, which is early retirement? What if you extend the period beyond a 30-year retirement? Well, the Poor Swiss looked at 50 years using data from 1871 to 2020, and of course we do have US inflation in there as well. And in this chart we've zoomed in a little bit more because, well, we don't really care about all of the the withdrawal rates where the success chance was very, very low, right? We really want to focus in on what are the variations between the portfolios that had a high chance of success. What were the withdrawal rates for that range? So here we're looking at a range of 3% withdrawal rate up to 6%. And we can see that for all the portfolios that were composed of at least 50% stocks, that they performed very well between 3% and 4%, but more so sort of between 3 and 3.5%. So it looks like around 3.5 to 4% is still looking quite safe, especially when we look at the higher stock portfolios like the 100% stock portfolios. But the chance of success isn't really the only thing that we'd care about. We'd also like to look at sort of the worst case scenarios and to get a sense of how bonds could potentially help us to weather against those really bad scenarios where there's negative or no growth right around the beginning of your retirement before your portfolio can really grow to where it's no longer really risky. So what we're really kind of zeroing in on here is something called sequence of returns risk, where it doesn't matter what the average is so much for your retirement, as it also matters what the order of the returns are as they come in. More specifically, we really care about what's going to happen in the early period of the retirement, say the first 5 or 10 years, because those can largely determine how successful the trajectory is going to be, as long as we have pretty good growth after that. So what we're showing here is the worst duration. In other words, the scenarios where you had the shortest amount of time that the portfolio survived in a number of months. And then we're seeing how that changes as we change the withdrawal rate. And here we can see that the extremes do very poorly in sort of the really extreme scenarios, right? So 100% stocks did not do very well at all, had quite a short duration. And the same is true also for 100% bonds. And so if you want to minimize this sequence of returns risk, the data here indicates that we probably want to have around 20% bonds or maybe 40% bonds or so in order to help mitigate that sequence of returns risk. All right, so all that being said, we've kind of come up with a strategy that would be maybe a between 3.5 and 4% safe withdrawal rate, and we'd be looking at maybe 20 or 40% bonds if you wanted to guard against sequence of returns risk. So how much would we need to save? At a safe withdrawal rate of 3.5%, our portfolio is still nowhere near $1 million. We're looking at $617,000 instead. Now, one last thing we haven't looked at though is, if we just focus on sort of the duration, right, the sequence of returns risk, and we also focus on the total chance of survivability or success of the strategy, we're also missing what the terminal values are for the whole value of the portfolio. And that's something that can vary a whole lot. In the stock-heavy portfolios, you end up with a much, much larger portfolio than you do in some of the other scenarios, especially, of course, the bond-heavy scenarios. And so that's why I'm taking a different approach where we really take advantage of that geographical arbitrage. So I am saving enough so that I will be able to fire with a 4% safe withdrawal rate here in the US, but for my initial retirement, at least, if not longer, I will be living somewhere where the cost of living is much lower, taking advantage of geographical arbitrage, and that way my withdrawal rate at that stage will be something more like 2.5%, and that'll provide the safety margin I need for my portfolio to grow beyond the initial sequence of returns risk. And then the nice part about that too is if for some reason I needed to fall back on my plan and move to somewhere where the cost of living is higher, then we know that at least using the 4% rule plus whatever safety margin I've built in up to that point, I should be in pretty good shape with a high chance of success. So that's the plan. Hope you found this helpful in coming up with your own retirement plans, or even just coming up with a potential goal to have someday. If nothing else, I hope this shows you that it's definitely an achievable thing, and I wish you success in your journey. With that, I want to say thank you very much for watching. If you liked the video, please hit the like button and consider subscribing. We have now hit over 100 subscribers, which is pretty awesome to me. I really appreciate it. Glad to see that this is entertaining and helpful for all of you out there. So thanks again, and I'll see you in the next video.